on financial economics. Your thoughts on growth inflation dynamics are very relevant during the present phase of financial crisis. Your views on the nature and hierarchy of financial regulation would bridge the gap between the countries known for sound financial system and India. We are keenly awaiting to hear you to gain insights into macroeconomic challenges facing our country. Thank you very much.
So on this momentous occasion, it's an honor and privilege to Dr. Subba Garu, Governor RBI, in our midst today to launch the Go to Jubilee celebrations. We express a grateful thanks to you, sir. May I now request you to address the gathering and things like that.
Thank you very much. Professor Ramarao Garu, Professor Mishra, Shri Sai Kumar, and all my friends and well-wishers present here. Thank you very much for inviting me to deliver the Golden Jubilee lecture of IPE. It's an honor to which I attach a lot of value. I've had long association with the IPE. I've attended a number of lectures there. I've had occasion to give a few guest lectures there. I know that what started in a humble way as an institute with a narrow focus on public enterprise has grown today to become a thought leader at the national level on a broad spectrum of policy areas. Besides, IPE has earned a formidable reputation for the quality of its teaching, training, and consultancy work. This is a tribute to the past presidents, past managements, past directors, presidents, deans, staff, and students of IPE. So I commend all of them on this occasion. I'm going to speak on macroeconomic challenges for India and Reserve Bank's perspectives. But before I do that, I want to raise and answer an important question. A most frequently asked question of me is, when is the crisis going to be over? In fact, that's what most finance ministers and central bank governors are asked. And none of them answers the question. But today I'm going to stick my neck out and give an answer. The answer is that you just note the day when I took office as the governor of the Reserve Bank, 5th of September 2008. That's very significant because on the 6th of September 2008, Fannie and Freddie happened. AIG happened on the 10th of September. Then every day after that, one storied institution after that, Merrill Lynch, Wells Fargo, collapsed. On 16th of September, Lehman Brothers collapsed and the global financial sector went into a tailspin. So in India, they associate the crisis with me. They said, Dr. Reddy left the Reserve Bank, he's held stability, and this guy had come and this created a crisis. Very good. So for 3 years, we had the crisis. I was appointed, as you all know, for 3 years. So my first term was finishing in 2011 September. In August 2011, on 5th of August 2011 actually, the government extended my appointment for 2 more years. And then 2 days after that, the European crisis, the Eurozone crisis, flared up in full bloom. So now if you want to know when the crisis is going to be over, you just have to know when I'm going to finish this job. And I know I believe a lot of people are praying that this guy goes away. Now I want to talk about India's macroeconomic challenges from a Reserve Bank's perspective. If you look at the broad contours of India's macroeconomic situation today, you will find that growth has moderated significantly. Last year, growth was 5%, which is the lowest in a decade. Inflation has come off the peak. Last month's number was 5% as measured by WPI. But retail inflation, as measured by CPI, is still quite high. The current account deficit is at a record high. And most significantly and most disturbingly, investment has decelerated. So if you look at the growth rate, that bar charts there show you the longer growth profile starting from 1950 until 2012-13, the most recent full fiscal year. If you see the second last bar there, the pre-crisis years, 2003 to 2008, those 5 years, India grew on the average at about 8.7%. This pre-crisis growth of India was celebrated. India was seen as decisively breaking away from the Hindu rate of growth. See the first red bar there in the immediate post-independence years, we all believed that we were condemned to a Hindu rate of growth at 3.5%. A large economy like India cannot grow beyond that. But this pre-crisis growth acceleration had actually demolished completely the Hindu rate of growth fatalism. So what this growth acceleration did was to set off aspirations for India's double-digit growth. India came to be seen as the most promising emerging economy, as the poster boy for international economics. That promising India growth story started fraying with the beginning of the global financial crisis in 2008-9. In the pre-crisis years, there used to be an intellectually fashionable theory, decoupling. People believed that emerging economies are decoupled from advanced economies, which is to say that even if advanced economies go into a downturn, emerging economies will not be affected because of their better macroeconomic management, their robust foreign exchange reserves, their healthy banking sectors, and most importantly, their policy space to deal with adversities. The crisis dented, if not totally demolished, the decoupling theory. If there's one country, one large country that should not have been affected by the crisis, that's India, because among large countries, we are the least integrated into the global system. But even a country like India was affected, demonstrating the contagion effect through the financial channels. So the current macroeconomic situation in India is that growth has moderated, inflation has come off the peak, but there are several upside risk factors. I'm not saying that inflation will flare up again, but I'm only saying that we have to be sensitive to the upside risk factors. The balance of payments is under stress, and as I said, very disturbingly, investment has decelerated. I'm saying disturbingly because today's investment is tomorrow's production capacity. So if investment doesn't take place today, we are actually not building the growth engine for tomorrow. In that context, I want to talk about three challenges in which the Reserve Bank is operating. Those three challenges you see up on the screen there. The first is managing the growth inflation dynamics. The second is mitigating the vulnerability of the external sector. And the third is managing the political economy of fiscal consolidation. I will give you the Reserve Bank's perspective on these challenges. And my purpose is to communicate the dilemmas confronting the Reserve Bank. Whenever I talk in a forum like this, the media tries to pick up signals about short-term policy calibration by the Reserve Bank. But I want to once again appeal to you that I'm speaking from a larger long-term perspective. To pick up any signals about immediate policy from what I say will be quite misleading. So let me get on with the first challenge. How do we manage the growth inflation dynamics? If you look at the graph there, which is the growth trajectory, this is for the more recent period actually, from 2006-7 to 12-13, the period of 7 years. You would note that in the pre-crisis years, as I said, we grew at 8.7% on an average. But actually, if you take just the 3 years before the crisis, we grew at 9.5% per annum on a compound average basis. Then we had the crisis, growth plunged to 6.7%. But importantly and notably, we had a classic V-shaped recovery. Even as growth had crashed during the crisis, it recovered very sharply. You see that V-shaped recovery. And then picked up our pre-crisis growth. In fact, in the first 2 years after the crisis, growth at 9% on the average compares favorably with the pre-crisis growth performance. But there has been a steep moderation after that. So the most important question is, why has growth moderated? To understand why growth has moderated, we need to understand why indeed growth accelerated in the pre-crisis years. In popular literature, that pre-crisis growth acceleration is attributed to a number of factors. The impact of economic reforms that we started in 1991, the impact of India integrating with the rest of the world, globalization, the rise of entrepreneurism, the increase in productivity, shift in terms of trade from urban to rural areas. All these factors are put forward as causes for India's growth acceleration. But underlying all these factors, what actually explains our growth performance is the increase in investment in the pre-crisis years. That increase in investment, importantly, was financed largely, and in some years completely, by domestic savings. And together with that, we had increased improvement in domestic and external competitiveness, improvement in the quality and quantum of financial intermediation, and productivity increase. So if that caused the growth acceleration in the pre-crisis years, it's the reverse conditions that are actually causing the growth slowdown in the post-crisis years. Investment has slowed due to external reasons, but also due to a number of local reasons, domestic factors. Business profitability today is dented by infrastructure bottlenecks, rising input prices. Business confidence is hit by slow and halting commitment to reforms and governance concerns, not just in Delhi, but across the states and even at the district and village level. So even as our growth slowdown has been triggered by the financial crisis, the growth slowdown after the crisis is a consequence of both external and domestic factors. If you want to look at the inflation story, that's the headline inflation as measured by the WPI, and the red line below that is the core inflation, which is the non-food manufacture, that is, you take out food and fuel from the basket and just measure the core inflation. But just focus on the top line. We had very low inflation during the crisis. In fact, for a few months during the crisis, we had negative inflation. And some people were worried that India might get into a deflation syndrome, because deflation can be much more dangerous than inflation. But not to worry, we came out of that pretty soon. Inflation went up steeply, and for about 2 full years, 2010 and 2011, inflation was in double digits or close to double digits. Only starting 2012, early 2012, has it started easing, and as I said, the most recent number has come below 5%. What drove that inflation episode? Mainly 3 factors. The first factor that drove inflation was food. Food inflation had been higher than headline inflation. And there are 2 components to food inflation. One is the cyclical component, the other is the structural component. The cyclical component of food inflation is relatively easy to understand. India is a large country with a very diverse agricultural situation. So any part of the country is affected by drought or flood or any weather adversity, we have cyclical food inflation. And that gets adjusted, or we just suffer it, and then it adjusts by itself. Normally, for a cyclical food inflation, there is no monetary policy response called for. But what is more important, more significant, is the structural food inflation, which has been an important factor. One of the most remarkable things that's happened in India over the last 20 years, one of the silent things that we don't recognize so much, we don't acknowledge so much, is the shift in terms of trade from urban to rural areas. That's happened for a number of reasons. I believe, importantly, because of the economic reforms. You see, one of the things that economic reforms did was to deprotect the industrial sector. So the industry sector that enjoyed protection up until the early 90s got deprotected. Therefore, the terms of trade shifted from industry to, from urban to rural areas. We don't recognize it so much. Also because of the affirmative action programs of the government, and a lot of money being spent on them, and a lot of money actually reaching the end beneficiaries, there has been an improvement in rural incomes. As a consequence of the rural income improvement, food habits in rural areas have shifted from cereal to protein. Rural people now eat more of vegetables, more of pulses, more of egg, more of milk, which is a remarkable thing, which is a very good thing to happen. And we should all be proud of that achievement. But nonetheless, because of this structural food pressure on protein foods, and because of our agriculture policies of support prices, etc., that necessary supply response to produce more protein food has not kicked in so far. And that's why we're having structural food inflation. So the first driver of inflation is food, both cyclical and structural components. The second driver of inflation has been the global commodity prices, especially global prices of crude oil. India imports 80% of its oil requirement. We are the fourth largest oil importer in the world. And global price of all commodities, importantly global price of crude, is an important determinant of our inflation situation. There's about 40% of the petroleum sector products which are non-administered. So if global prices go up, that translates that inflation gets imported to the Indian price system. About 60% of the petroleum sector prices are administered. So that 60% is protected from the global prices. But then what happens is that to the extent that there is global price increase, to the extent domestic prices are not adjusted, government subsidizes. If the government subsidizes, their fiscal deficit bill goes up, and as a consequence of that, we have inflation. So both on the administered segment and the non-administered segment of petroleum sector, we have inflation impact. On top of that, we've had depreciation of the rupee over the last 2 years. As a consequence, the non-administered price had taken the beating. That's the second driver of inflation. The third driver of inflation is the demand pressures. As I said, rural incomes have gone up. They were at a low level. When incomes of low-income households goes up, consumption increases because they have a higher marginal propensity to consume. In an economy with a per capita income of $1,500, any income increase quickly translates to increase in consumption, which again is a good thing to happen, but nevertheless, it's put pressure on inflation. Even as rural incomes have improved, one thing that's not happened is rural productivity has not improved. And as long as you have a differential between wages and productivity, that triggers inflation. So, to summarize the growth inflation dynamics, there's a transition from pre-crisis to post-crisis. The pre-crisis growth inflation dynamics were quite different from the post-crisis growth inflation dynamics. The economy expanded at about 9.5% on the average in the 3 years before the crisis, but now growth has gone down to 5%. What's the Reserve Bank done to control inflation? And has the Reserve Bank succeeded in reining in inflation? What's the Reserve Bank done to control inflation? We tightened monetary policy, we raised the CRR, the cash reserve ratio of commercial banks. We raised the repo rates by 13 times, as our critics never let me forget. So we raised the repo rate by 13 times. However, in the wake of inflation easing, growth moderating, starting January 2012, we started easing monetary policy. We reduced the CRR, we reduced the repo rate. The Reserve Bank's management of growth inflation dynamics has been criticized. As a public policy institution, I believe we should be open to criticism. I also want to say that in the Reserve Bank, we value the criticism, we learn from that, and it keeps us alert and keeps us on our feet. And where necessary and where important, we also respond to that criticism. I don't want to go into a full defense of the Reserve Bank's policies, but I just want to address two criticisms